The market overall continues to remain very buoyant here. There's not really much that seems to be really impairing the markets right now. Nobody's really concerned. Even though August and September tend to be the weaker months of the year, that hasn't been the case this year so far. Markets haven't done a whole lot over the last several weeks, but they're not going down either. We're not having this corrective cycle. So again, when we take a look at the underlying structure, there's a lot of concerns, and a lot of those narratives are now starting to kind of fade into the background as we kind of keep moving forward. Those short-term narratives, when they fail long enough, then eventually people move on to something else. And right now, there's not a lot. Focus is on the Fed. Again, markets just continue to kind of just hold and gravitate above the 20-day moving average. We've had a very, very large rally since that April low, and people have forgotten about all of that. But again, that reset that we had in the markets at that point kind of reset that table a bit for this type of a rally, and it's been a very nice one so far. One of the big supports for the markets continues to be the fact that professional managers remain underweight equities, particularly in the Mag 7. That buying power keeps holding this market up. And again, we have a very big short position against the overall market as well, which also adds to support, because the bigger that short position is, then when they have to cover, it helps support markets. Markets keep going up because money flows are chasing markets. And we've seen a very big increase in money flows here just over the last several weeks. Markets, again, on a variety of bases, there's some things that are getting pretty overdone here. As stocks continue to do well, we're still seeing that negative divergence in relative strength, negative divergence momentum, but we do have a very decent gap between where the market's trading and that 200-day moving averages. When you get these larger gaps from moving averages, they act like gravity, so they want to pull things back eventually towards those moving averages. And again, this is what happens and why we have these corrections. We get these big deviations, then markets have to correct back to the moving averages. That deviation's getting pretty large here. Now, it doesn't mean that you're going to have an immediate correction tomorrow. It just says that eventually we're going to close this gap. And we've seen this repeatedly over history. It's why markets go up and down. It doesn't seem like the risk of a correction is high. There is a risk of a correction, and that correction could be up to about 8%. Again, that would just be completely normal. The fact that we had a 20% correction earlier this year kind of minimizes that risk of another massive correction this year. Those don't happen very often. So again, there is that risk of some type of correction here just because of that deviation we have in the market. Catch me daily on The Real Investment Show. The link is in the description.